Most people will never build real wealth from investing. Not because the market is unfair. Not because they started too late. Not because they did not have enough capital. Because they never had a framework. Welcome to the ProfitByFriday.com podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Let us get into it. Marcus sold the stock on a Thursday morning. He was up 8% in 11 days. The position had worked exactly the way he planned. He felt smart. He took the profit, closed the trade, and moved on. 32 days later, he pulled up the chart. The stock was up 55% from his entry. He had made money, real money, and he had still gotten it completely wrong. This is the mistake that costs investors more than any losing trade they will ever make. Not the stocks that go down, the stocks that go up without them. The winners they sold too early because they had no idea where the stock was actually going when they bought it. Marcus did not have a price target when he entered the trade. He had a feeling. The stock looked good. The setup was clean. He thought it might go up 10 or 15%. When it hit 8, he got nervous and sold. 8% felt like enough, because he had never decided what enough actually was. Here is why this keeps happening. Think of it like driving to a destination without knowing the address. You get in the car. You start driving in the right direction. After 20 minutes, you pull over and ask yourself whether you have arrived. You have no idea. You do not know where you are going. So you stop at the nearest exit that looks reasonable and call it done. Every investor who sells too early is doing exactly this. They entered the trade without an address, without knowing where the stock is supposed to go, without calculating what the move is actually worth relative to the risk they took. So when the stock moves in their favor, they sell at the first exit that feels comfortable. Feeling comfortable is not a price target. It is anxiety wearing a disguise. A price target is a specific number calculated before you enter the trade, not after the stock starts moving. Not when you are sitting on a profit and getting nervous. Before you buy a single share, here is how you calculate it. The clear framework requires a risk-reward ratio of at least 3 to 1 before any trade qualifies. That means for every dollar of risk you take, you need at least $3 of potential reward. You already know your risk from the stop-loss rule. The stop goes below the base structure. The distance from your entry to your stop is your risk per share. Now you multiply that by 3. The result is your minimum price target. Marcus bought the stock at $52.40. His stop was at $47.20. His risk was $5.20 per share. 3 times that risk is $15.60. His minimum target was $68. The stock went to $80. He sold at $56.60, 8% up, $4.20 per share. He took $4.20 when the trade was offering at minimum $15.60. He left $11.40 per share on the table because he never did the calculation before he bought. Think of it like a contractor giving a quote. A good contractor does not start the job and then figure out what to charge when the client starts asking. He calculates the materials, the labor, and the margin before he lifts a single tool. The quote is and before the work starts. The number is decided before the first nail goes in. A price target is your quote. You calculate it before the trade starts. Not during, not after. Here is the second reason. Investors sell too early. And this one is harder to fix. They do not trust the thesis. Marcus did the work. He ran the stock through the clear framework. Strong score. Clean base. Volume confirmed the breakout. Stop was correctly placed below the base. Target was $15.60 above entry. But when the stock pulled back 3% on day 4, he panicked. He started wondering if he had missed something. Started reading news articles. Started second-guessing the score. On day 11, up 8%, the anxiety was louder than the framework. He sold. The stock never violated his stop. It never closed back below the base. The thesis was intact the entire time. The price target was never reached. But Marcus sold anyway because he felt uncomfortable holding a winning position. Think of it like planting a tree. You plant a tree and give it water. 3 days later, the leaves look a little droopy. You dig the tree up to check the roots. The roots look fine. So, you replant it. Then you check again 2 days later. And again 3 days after that. Every time you dig up the tree, you are damaging the roots. The tree that could have grown 20 feet tall never gets there because you kept interrupting the process. A stop loss is your instruction to sell when the thesis breaks. If the stock has not hit the stop, the thesis has not broken. Sitting on an uncomfortable profit is not a reason to exit. It is a reason to review the original work and confirm the stop is still in the right place. 3 rules. Write them down. Rule 1. Calculate your price target before you enter the trade. Entry minus stop equals risk. Risk multiplied by 3 equals your minimum target. No target, no trade. Rule 2. Do not exit a position that has not hit its stop or its target. Up 8% is not an exit signal. Up 8% with a target of 30% means the trade is 22% from completion. Rule 3. Review the thesis, not the price. When a stock makes you uncomfortable, go back to the clear framework score. If the score is still valid and the stop has not been hit, hold the position. The discomfort is the cost of the return. Marcus had the right stock, the right entry, the right stop, the right target. He just never wrote the target down before he bought. So when the position got uncomfortable, he had nothing to hold on to except a feeling. Feelings are not a framework, and they are what you replace with one. Amateurs sell when they are comfortable. Investors sell when the target is reached. Visit profitbyfriday.com today. Subscribe free to the Friday Flash, where you will receive one stock fully evaluated through the clear framework every Friday so that you know everything about the company before you decide to invest. No noise, no hype, just the analysis that matters. We trade for cash flow, and we invest boring to build legacy. See you in the next episode. Bye for now.